silver can shoot up by tens of dollars in a few weeks. So we're now, around 30, let's say. The move to 50, where we were in 1980 and where we were in 2011, to $80, that's going to be extremely quick.
Ladies and gentlemen, another month has passed. I welcome dear Egon von Greyerz in Zurich in his office. Egon, great to see you. We are witnesses to history, our viewers, of course, also. It's really time to protect what you have. Gold touched 3,500. I really expect a breakdown in chaos. Who knows? Time to prepare and many things to discuss.
Yes, well, hello, Jan. It's so good to speak to you again. Well, this is, you couldn't have written a better script than this. And of course, it's played out beautifully. I mean, I've been following this in over 25 years, at least, the gold market. And it's just, it's taken time for the whole world to discover that gold is actually something that they should look at. Now the sentiment has changed and people are starting to get worried. And of course, gold is now on the front pages every day, which is a big change to before. But it doesn't change the pattern. We know what's going to happen. We know it was been clear. It's been clear for what's written in history, actually. Because history always tells you that this is this is the end game. And as when we talk about history, the Winston Churchill, there was a quote from him. He says, "The longer you can look back, the further you can look ahead." And basically saying that if you understand history, you understand what's likely to happen. And this is why we started with this 25 years ago, because we saw that this debt crisis was going to develop to probably chaos and the collapse of the current system. And that's what's happening or starting to happen now. So it's quite exciting. But this is we've got many chapters yet, but it's now accelerating. So we've got to go much faster, Jan, and that's what we're going to talk about in the next few months here, I'm sure.
I agree, Egon. The Dow Jones yesterday recovered, and who is buying? I have here two articles, one from Australia, one from the US. It's the retail buying. As you said, some never learn and pattern repeat itself. First, we have here the Dow Jones clearly in a downward trend yesterday through Trump's statements. It went up 1,000 points. But here, who is buying? Why are a record number of retail investors buying the dip from Australia? Despite uncertain times, a record number of retail investors are viewing market turmoil as an opportunity to buy equities at a cheaper price. Retail investors are taking the opportunity to buy the dip. Such investors appear undeterred by warnings of recession, stagflation, or heightening geopolitical conflict. And here the second one from Reuters. JP Morgan reports retail investors buy stocks at the largest level in 10 years. That is from the beginning of April, but it shows us the same problem. It seems Joe Sixpack is simply not getting it, right?
Well, this is history repeating itself again, Jan. I could have predicted this, and so could you, because the investor, and especially the less sophisticated retail investor, has got spoiled. You could just start back in 87, for example, and go further than that. But 87 was this massive crash, and I remember it well, and it recovered very quickly with the help, of course, of central banks and especially the Fed. And then you had the same a big one again in 99, 2000, and it took a bit longer to recover. And then you had another one in 2008, and that recovered too. So we know that with unlimited money printing and lowering interest rates, the central banks have been able to manipulate the markets in an artificial way, and therefore investors, for them, it's been wonderful because they know you must always buy the dip. You always make money by buying the dip. Okay, they lost money on the dip first, but then if they have any reserves, they buy a bit more. But this time, we've talked about it, Jan, many times. This time, I think this is not the time to buy the dip. This is the final drop that is now starting, and that's going to go on for 5 years, 10 years, or even longer. Obviously, it's not down all the time. It's going to be down and then sideways and corrections up, etc. But the general trend, the stock market, mirroring the world economy, is going to be down for many, many years, possibly decades, as I said. And therefore, anyone who buys the dips is going to get slaughtered. And in the end, of course, they're going to buy all the way down until they have no more money left. And we've seen that before in history, and it's going to happen now this time again. And it says, as you showing in the article there, biggest buying for 10 years by retail investor. Sadly, they're uninformed and they don't understand what's happening.
And even if the Fed and other players can keep up the market in nominal terms, they surely will not beat the gold price. So gold in real terms will surpass. And we have an interesting observation later in this interview. But let's come to the real problem for the Fed. They have to fight, on the one hand, inflation, and on the other hand, they have to support the economy. And this brings them to a conflict. They cannot solve it. And therefore, the key topic today, hyperinflationary depression. But let me show first the inflation rate. Here it is, and of course, far away from the 2% the Fed intends to achieve. And what we also expected and what you predicted for a long time, the interest rates have turned. We see here the 10-year yield clearly turned and moving upwards. If you look on the long-term perspective, it's even more profound, the low in 2020, and that's not going to come back. So the real yields are increasing, and the Fed is in a big dilemma. Fed Chair Jerome Powell said Wednesday that the central bank could find itself in a dilemma between controlling inflation and supporting economic growth. Powell gave no indication on where he sees interest rates headed, but noted that for the time being, we are well positioned to wait for greater clarity before considering any adjustments to our policy stance. I think we will see higher inflation, and that shows already the dilemma.
Yes, absolutely. No, first of all, what Powell said is not what the Fed's mandate is. The Fed has two mandates. One is to keep inflation under control, and two, to support the labor market. There's nothing in the Fed's mandate that says about that create growth in the economy. And of course, you can't, on the one hand, keep inflation under control with higher interest rates, which is the only way they know how to keep it under control, and at the same time boost the economy. And that's the dilemma. And of course, now you have a debt burden which is greater than ever in history, but it's going to grow, as we know. It's going to grow by at least a couple of trillions a year just in the US, for the simple reason that that's the deficit, the annual deficit that is forecast for coming years and for many years. And I think it's going to be a lot higher because you're going to have problems in the economy. You will have a government that needs to support the banking system, support people who are suffering, etc. I think the money printing will accelerate, and I think the inflation rate also will accelerate, because you can't keep inflation down and print money simultaneously. There's just an impossibility, and that's where we're going to see the inflation increasing, and we're going to see possibly hyperinflation. That's what I've been forecasting for 25 years. To what level, we don't know, but it always happens at the end of an economic era, when money printing accelerates. Then that is the only tool that central banks have to print more money, and printing more money that has no value leads to inflation and hyperinflation. So that's what we're looking at now, Jan, for coming years. That's what people should prepare for. And prepare means, covering themselves in the only asset that actually maintains its value, which is gold and silver in inflationary terms. And it's interesting now just to take the stock market. The stock market has lost 30% against gold this year, and people are still chasing the stock market. The Dow Jones is down 30% against gold just this year. And therefore, people are chasing the wrong instrument but they don't even know about gold today. Yes, we're seeing more gold buying. Yes, we're seeing more clients coming into us for wealth preservation purposes. But on the whole, the masses are not buying gold because they still think that the stock market is going to save them at all times.
A good point, Egon. I just thought about one point I can disagree with you because gold is not yet a mainstream topic. It is in uncharted territory. We have nominal highs touched 3,500, but it's far away, for instance, from the situation in 2011. But let me come back to this Fed dilemma because of Trump. He requests from Powell to lower the interest rates. President Trump again called on Jerome Powell to cut interest rates after threatening to oust the Federal Reserve chairman last week. There can be a slowing of economy unless Mr. Too Late, a major loser, lowers interest rates now. The president posted on his social media website Truth Social Monday morning this week, saying that preemptive cuts in interest rates are being called for by many. The president pointed to how Europe has already lowered rates 7 times and that Powell has always been too late. What other chance does Powell have? I think no chance. But one key driver of inflation is, of course, Trump himself with his tariffs. So I would suggest Powell simply to step down and to leave it to others. But we have in Europe, Egon, for instance, the same problem. We have not imposed tariffs on anybody, but we waste money and we spend it for other stupid purposes. For instance, energy transition, war spending, etc. So each side of the Atlantic does stupid policy to drive inflation upwards.
Central banks should not exist, in my view. I've been saying that many times. And they have no purpose whatsoever. Interest rates and markets should self-regulate, especially when it comes to rates, borrowing, and lending. If they self-regulated by controlled by supply and demand, we wouldn't have these massive peaks and these massive bottoms that we are seeing now, and the bottom that we are going to see is going to be worse than ever in history. Well, Powell will not go, of course, and that's clear now. And even Trump said yesterday that because he can't afford another crisis with firing the whole of the Fed, that would just be with the end of the dollar very quickly, and the U.S. economy. So he won't do that, and that's why the market went up yesterday. But nevertheless, rates are now cannot be controlled by the Fed. They try with the short rates, but the long rates are determined more by the market, and that there is an unlimited demand today and in the future for further financing of the U.S. deficits. And there is only one buyer of U.S. debt, and that's the Federal Reserve. That means the government issues the debt, and the Federal Reserve um, then prints more money, and that leads to higher inflation and higher interest rates in a a very dangerous cycle that, in the end, as we said, could lead to hyperinflation. So that I'm absolutely convinced that rates are not going to come down more than temporarily. The trend is up. The trend, I experienced the 70s, which was nowhere near as bad as today. We saw rates at 15 to 17% in many countries. And I told people many times on my first mortgage in the UK in 1973, I paid 21%. How many people could pay 21% on the mortgage today? Nobody. But that's what's going to happen. Maybe not that high, well, or maybe there will be that high and the housing market is going to collapse, and the commercial property market is going to collapse because that is a bubble anyway, and you cannot live with high interest rates. But you said the Fed and central banks will lose control of interest rates. Whatever Trump wants, he's not going to succeed because the market will tell him that you cannot borrow unlimited amounts of money and at the same time have low or zero interest rates. It just doesn't work. The US will have a problem and they will suffer dramatically. The dollar will fall, the US economy will fall, the stock markets will fall, bond market will fall, which means higher interest rates. And a lot of the bubble assets will also come down. Just take private equity, for example. Private equity is another it's another leverage Ponzi scheme that in the next few years is going to collapse also, in my view, because they have a lot of overvalued assets it only works private equity when the stock market goes up and you can sell off the investments. When you can't anymore and you have massive leverage, that industry will also have major, major problems. So that's just one. Property market, the same as we said. So, Jan, there is nowhere to go. There is nowhere to go. Gold is not the solution to all the problems, but it is now changing its role from before having been seen as you know, as an interesting relic. Now, what in the last, especially since the 19 let's say since the 1970s, all of a sudden now is taking another role, partly because central banks outside the Western central banks, the BRICS countries, etc., they're all buying gold. And gold is going to become a reserve assets in the balance sheet, or is already, of central banks. So we have a permanent now re-rating of gold taking place, and that's going to last for many years. And I think that will lead to gold not looked upon as just another investment asset, but as real money again, and therefore as something that people will have to hold and and the percentage will go from 0.5% to maybe 10% or more of financial assets in the world going into gold. On top of that, of course, we have Basel III, Jan. Now, gold is a tier one asset, which means it's uh, equal to government bonds and equal to cash in the balance sheet of banks. But to me, that's just laughable, because gold is so far superior to cash, which goes down by the day, and bonds have zero value or will have zero value because no government is ever going to repay the bonds. So therefore, gold is far superior to those two assets, and therefore the demand for gold will be so much increased in coming years, and that can only be supplied by not more gold mining, but higher gold prices. And that's what we're going to see here.
Many houses of cards will come down, Egon, and as you said it already, gold is the place to be. I have here an article also from Yahoo Finance that says that gold has surpassed the Magnificent Seven stocks as the most crowded trade on Wall Street, as the precious metal surged to record highs this year amid volatile markets and an uncertain economic backdrop. According to latest Bank of America fund managers survey published this week, nearly half of the fund managers surveyed, 49%, see long gold or bets that gold prices will rise as the most crowded trade in the market right now. And we know, Egon, it's a bit overheated right now. So if somebody is out there who doesn't own any gold yet, I at least would suggest you have to be in this market, maybe not at 100% at one point, but you should be in there because the risk is clearly that it moves further up than down. What's your opinion?
Well, definitely. You mentioned the Magnificent Seven, of course, which was everybody's baby for many years now. And of course, there was always a bubble. They're down, well, they're down 30% this year, Magnificent Seven. And gold is up 27% this year. I think so. That tells you the story. Right now, you should not hold stocks. I mean, the Dow Gold is down 30% this year, and that's just the beginning. My forecast. I think stocks against gold is going to be down by at least 90%, maybe 99% over the coming years, um, because stocks are in a bubble and gold is just starting a re-rating. And that's, as I said, that's not speculation. That's a permanent re-rating as the only asset that actually is real money. And so we're back where gold started and where it has been for 5,000 years. And that's happening now again. So people should not think about gold as something that's going to just temporarily be a hot commodity. No, it's not a commodity. It's real money, and it is not over bought or overvalued. It's going to go up by multiples from here for the simple reason that it's now re-rated totally and as a proper investment asset and the only thing that backs a rotten system because all the other monetary assets have been overinflated to such an extent that we're going to see, as we said, sadly, a major collapse of all these bubble assets. So therefore, people should not worry about the fact that gold is high, and if they haven't jumped on the gold wagon yet, it's not too late to do it now because gold is going to go up by multiples from here. Of course, there will be corrections. Of course, there will be periods of sideways moves, but the general trend of gold against all other assets is just starting to go up now. It's going to be up for many, many years.
Egon, from time to time, we talk about the Buffett indicator, the overvaluation of the stock market. But today, Warren Buffett's holding Berkshire Hathaway. That's a funny fact in our program today. Now, it was for the past 27 years, it was better to simply hold gold, and gold bet Warren Buffett's famous stock. Here's the fitting graphic that I found from Lynn Alden on Twitter. Amazing fact, and I think Warren will be a bit worried about that.
Yes, well, you must give it to to Warren. I mean, he's done extremely well. Even compared to the Dow. I mean, he's outperformed most indices and kept pace with gold now coming off. But sadly, Warren Buffett's portfolio, like all others, will suffer, and in real terms, that is measured in gold. That company's stock will go down also quite substantially, in my view, because it's going to be the whole market. There's nothing that's going to outperform by any major degree in coming years. But it's going to be a dilemma for investors because everybody can't just buy gold. There isn't enough gold to buy, so people will hold other assets, and people will suffer, and there will be the massive destruction of wealth for the world as a whole. That is inevitable now because the majority of people will hold on to their stocks, hold on to their bonds, hold on to their property. People only sell on the margin because that's the only thing that the market can stand. If everybody sold, the market will be down to zero within a day. Um, that's these only markets are only traded at the margin. And as I said, if you had everybody panicked, then as I said, within a few days, all markets will be at zero. I don't expect that, certainly not yet, but the trend is going to be down, and it's going to be down massively on, and therefore people who have savings should definitely hold some physical gold, hold a bit of silver also, and hold it obviously outside the banking system, which is unlikely to survive in its present form.
Absolutely, Egon. Silver, that was a good keyword. The gold silver ratio is over 100. I think silver has a lot of room to pick up to the increase in gold prices. But there's one question I wanted to ask you. Do you see already a shift in perception that people come to you and want to protect wealth? Gold is more than just used for jewelry or a barbaric relic. It will be, in fact, in my opinion, a question of survival. Do you see this shift already?
Well, we are seeing it, Jan. Having been in this market for 25 years in the gold market for wealth preservation reasons, for us, what's happening now is what we expected to happen. There are obviously, as you can tell from the gold price, there are now more investors coming in to buy gold. Um, and so we are seeing also, it's not a panic at all, and there's still gold is still available. I think that there will be supply problems in future months or years, but right now you can still get hold of gold, and people are buying uh, more than well, it's more than ever right now. Yes, they are. But it's not no panic yet at all. I think the panic will be also more in the silver market, where there is a massive deficits and have been for years, and that's been financed on the COMEX in the futures market. Um, and that's so the silver is very, very dangerous to be short now, because at some point, and there are many shorts in the silver markets by big banks, but at some point that will break that support, and gold or silver can shoot up by tens of dollars in a few weeks. So we're now, around 30, let's say. The move to 50, where we were in 1980 and where we were in 2011 to $80, that's going to be extremely quick. But it won't stop there more than momentarily. And I think silver will go a lot higher than that. But as we always warn, it's not for widows and orphans. Silver is very volatile. So if you buy it now, buy it cheap. Don't buy it at $50, because $50 there'll probably be a correction, but only temporary, as I said. But it's always better to buy all these assets when nobody wants them. And right now, everybody's buying gold. They're not buying silver. So now is the opportunity to buy some silver. I think still the wealth preservation assets should be mainly in gold. We tell our clients 25% silver, 75% gold. I think that's a reasonable split between the two. But the opportunity right now is in silver. There's no question about it.
It was a good final statement, Egon. I agree. What else should I do? It's time now to protect your purchasing power. Uwe Bergold recently said gold is just money and sitting there. But if everybody else's purchasing power is going down and you can keep yours, what does that mean at the end? That is obvious. Egon, thank you for today. I wish you a good day in Switzerland, and till next month, who knows what we have to report then? My goodness, it's hard to keep the pace.
It certainly is. And when you have a president like Trump who changes his mind every day, it makes it certainly more exciting. But you have to remember he's in charge of the biggest economy in the world. So it had the implications for the world economy are mind-boggling. But as I said in the recent newsletter, came out yesterday actually, Trump is not the one causing all of this. We're at the end of an era, and it's the debt and the deficits that are causing all the problems. Trump is not the one who's causing the stock market to go down, for example, or the dollar to go down. That was going to happen anyway. He just happens to be the instrument or the tool or the catalyst for this happening. And he's a very good one, because he's totally erratic and capricious, changing his mind on a daily basis on tariffs, for example. So that makes it more amusing to watch. But don't think that he's causing all these problems. It's actually that we are at the end of a major monetary era, and that's the problem. And there's always has to be a leader who takes the decisions that makes this happen. Happens to be Trump now, and that's why, as I said, I know it sounds strange to say, but it is amusing to see all of this happening. At the end of an era. But that's when you get the most crazy decisions. So we have a lot of interesting moves to watch, Jan, and we have to laugh in between also. because the general trend, of course, is going to be bad for the world and bad for people. But nevertheless, we have to sometimes see it with a bit of humor also.
Oh, yes, Egon, we have to. That was a good statement. Till next month, a good time in Zurich. Grüezi.
It's all. Thank you.
Bye bye.